smaller is absolutely the way to go, and everyone's talking about how they think they can decrease their footprint, whether it's a Staples or a Best Buy. We've been looking for REITs that would be most affected by that. I haven't been able to find one with enough quite bang for the buck. Maybe something like a Kimco that has a lot of Sears Holdings real estate. It's just interesting to me. The trend has totally changed 180 degrees. I think we'll see that for a while, but the REIT stocks still get a bid for their yield.
Welcome, Matt. That was, of course, Karen's take on the REITs back in September. And things have certainly changed right now in terms of the retail situation and who may or may not be looking to renegotiate.
Well, I think everybody's looking to renegotiate. Yeah. I don't know why earlier today, before the stock market sort of turned around, and for whatever reason, the whole space was really getting hit. And it's interesting to me when, I don't know why, all of a sudden they rang the bell and everybody's afraid, okay, you know, the mall REITs in particular, getting very hard hit today. That trend is still continuing, though. Everybody wants to reduce their rent expense, either through footprint or price or both.
Right.
That's going to continue.
All right, let's bring in Craig Leupold. He's the president of Green Street Advisors to dig deeper into this issue. And obviously, Craig, as Karen had mentioned, a major sell-off for the REITs. Should we be concerned when we hear about the likes of a Barnes & Noble and a Best Buy in particular wanting to reduce its footprint specifically, and these are the anchor tenants that a lot of other retailers have named in their co-tenancy agreements. Should we be concerned for these mall REITs?
I don't think so. Certainly not when it comes to the higher quality portfolios. We certainly are seeing a bifurcation between the performance of high quality portfolios versus low quality portfolios. But you have to remember that retailers are a fairly dynamic group. As much as some are reducing footprints and some are going out of business and bankruptcies and other things, there are always new concepts being invented and there's always expansion going on.
It sounds like you're very, very optimistic. I mean, do you see any of this going on, though, in terms of renegotiating their leases, a Best Buy or Barnes & Noble, using that spot as a major anchor tenant to their advantage? And then also the corollary impact of other retailers saying, you know what, let me out of my agreement because there's no more Barnes & Noble in this mall.
Yeah, I think, and again, that speaks to the lower quality portfolios more so than high quality portfolios. I mean, if you're a retailer and you're one of the remaining anchors in a B quality mall or a C quality mall, certainly you have more negotiating power than you do with an A quality mall. As new formats are being coming into the marketplace, or there's expansion going on, you know, tenants would like to be in A quality, high productivity malls. And so I don't think you really have the same bargaining power with, say, a Simon Property Group or a Taubman who own high-quality malls and have, you know, they own the portfolios and the properties that most retailers want to be in.
It's Karen, let me ask you, where would you put then a Regency or a Kimco or one of those? And would you be advocating something like a pairs trade, long the A quality, short the B quality?
Yeah, you know, that's kind of been a trading strategy for much of this year. We think that it will continue. I mean, certainly as credit has become less available for not only retailers, but more importantly for real estate owning companies, we've seen a bifurcation in terms of what's happened with valuations for higher quality real estate versus low quality real estate. I would say also that, you know, to your question about Regency, you know, there's a company that owns a fairly high quality portfolio. We have a buy on Regency at this point. And I would certainly advocate establishing a position in a Regency. Same with on the mall side, same with a Simon or a Taubman.
In terms of the shareholders that were owning these stocks, we just talked about, you may not have heard in the desk about the move from bonds into equities. What about the move from high-yielding equities, such as REITs, utilities were sold today as well, into other stocks, high-beta stocks? So have a lot of people been hiding in the REITs, and now that'll cause a downdraft in the stocks or not?
Well, I think it's more a story of what's happening within the commercial real estate market generally, which is fundamentals have been improving throughout the year. The outlook for the economy was fairly good. You know, over the last quarter or two, clearly a lot of that has started to change. The one silver lining, if you will, for commercial real estate is supply is significantly in check. We're not seeing new development happening, so you know most of it is really kind of fundamentals driven at this point. Certainly there is some concern about, we've had a repricing of risk, and I think that's some of what we're seeing with the performance of lower quality REITs versus higher quality REITs. In terms of a movement out of REITs and into other higher beta stocks, you know, as we've looked at REITs and you see where REITs are priced, relative to the S&P 500 on a multiple basis, we look at REITs and say, wow, they're pretty expensively priced. They're at a high valuation relative to the S&P 500. However, you can contrast that with looking at REITs versus bonds, and you look at REITs versus bonds and you say that, REITs are fairly attractively priced. Right. And so it's sort of a tale of, what's your metric? What are you looking at? Are you looking at, is REITs as a proxy for equities, or REITs as a proxy for yield, and they're somewhere in between a bond and an equity.
Craig, great to speak with you. Hope to see you again soon. Craig Leupold of Green Street Advisors.